If you're planning to retire in the next 10 years, this video could be worth $847,000 to you. Today, you're going to learn 7 completely avoidable tax mistakes. And the worst part, most people don't realize they're making these mistakes until it's too late to fix them. All right, so let's get right into it. Mistake number 1 is waiting until 73 to take your first IRA distribution. That single delay can cost you $127,000 in unnecessary taxes, and it's completely avoidable. My name's Brian. I've been a financial advisor for 25 years, and I've watched people make 7 retirement tax mistakes that can cost a combined $847,000. Today, I'm breaking down all 7 so you don't have to make the same expensive errors. So mistake number 1, let me show you exactly how that $127,000 mistake happens. Most people think, I'll just wait until the IRS forces me to take money out at 73. But here's what they miss. Every dollar you delay strategic withdrawals between retirement and 73, you're possibly pushing yourself into a higher tax bracket later. And here's the math. Let's say you retire at 65 with $750,000 in your IRA. At a 7% return, it's worth $1.7 million by the time you're 73. If you take out 0 withdrawals for 8 years, your RMD at 73 will be roughly $47,000. Add that to Social Security of $35,000, and you're suddenly in the 22% tax bracket, paying about $10,000 in federal taxes on that RMD alone. If you had taken just $30,000 or a 4% withdrawal per year from age 65 to 72, you would stay in the 12% tax bracket. Over those 8 years, that's about $28,000 in taxes versus $82,000 you'll pay over the next decade with forced RMDs. The difference, about $54,000, and that's just the first mistake. So action step is if you're between 59.5 and 73, calculate your future RMD using the IRS Uniform Lifetime Table. Then work backwards to fill up the 12% tax bracket each year with strategic withdrawals. Mistake number 2 is Roth conversion timing, converting to your Roth in your highest earnings years. I see this constantly. Someone reads about Roth conversions, gets excited, and converts $100,000 while they're still working and earning $180,000. They just paid 24 to 32% in taxes to convert money that they could have converted later at 12%. The sweet spot, the gap years between retirement and RMDs. That's when your income drops, your tax bracket is probably lower, and conversions become incredibly efficient. Here's a real example. My client Lisa retired at 64 with $900,000 in her IRA. For the next 9 years, she converted $40,000 annually, staying in the 12% tax bracket because she was delaying Social Security. Total cost, $43,200. She paid the taxes from her taxable brokerage account and lived off some income from dividends, took capital gains from her brokerage account at 0 to 15%, and some small IRA distributions when needed. If she waited and taken RMDs starting at age 73, she would have paid 22 to 24% on every dollar for the rest of her life. On a $900,000 IRA, that's an extra $180,000 in lifetime taxes. So the action step is if you're still working, pause Roth conversions, mark your retirement date on the calendar, and plan your conversion strategy for those gap years. Mistake number 3 is ignoring state taxes. Forgetting about state taxes on conversions. Everyone focuses on federal tax brackets, but if you live in Minnesota, California, New York, or New Jersey, you're paying an extra 5 to 13% on every conversion dollar. Here's the strategy high tax residents miss. If you're planning to relocate to a no tax state like Florida, Texas, or Nevada, delay your conversions until after the move. I had a client in California with $600,000 to convert. California's 9.3% rate would have cost him an extra $55,800. He waited 8 months, established Florida residency, then converted. He saved every penny of that state tax. So the action step is Google your state retirement tax friendliness and compare it to your potential retirement destinations. If there's a big gap, time your conversions accordingly. Mistake number 4 is the Social Security tax trap. Triggering Social Security taxation with large IRA withdrawals. This is the stealth tax that catches everyone. Up to 85% of your Social Security becomes taxable once your combined income hits $34,000 for singles and $44,000 for married couples. Here's where it gets expensive. Every dollar you pull from your IRA adds to your AGI, which pushes more of your Social Security into taxation. It's a double tax hit. Let's say you're taking $30,000 in Social Security, $40,000 from your IRA. Your combined income is $55,000. $40,000 plus $15,000 because half of your Social Security is used to calculate your combined income. That puts 85% of your Social Security, or $25,500, into taxable income. But if you had done Roth conversions earlier and you were now pulling from Roth accounts, that's $40,000 that wouldn't count towards your combined income. Over 20 years of retirement, that's $102,000 in savings. So the action step here is calculate your future combined income. If you're over $44,000, prioritize Roth conversions now to reduce future IRA withdrawals and pull from your taxable brokerage account for income. Mistake number 5 is Medicare IRMA penalties. Spiking your income and triggering IRMA surcharges. IRMA stands for Income-Related Monthly Adjustment Amount. Basically, it's Medicare's way of charging high earners more for Parts B and Part D. Here's the trap. IRMA looks at your income from 2 years ago. So if you do massive $200,000 Roth conversions in 2025, you'll pay IRMA surcharges in 2027, even if your income is low for that year. The surcharges aren't small. For a married couple, crossing $206,000 in modified adjusted gross income adds $4,280 annually to your Medicare premiums. I've seen retirees do $150,000 conversions without realizing that they're about to pay an extra $10,000 in Medicare costs for the next few years. So the action step here is before any large conversion or withdrawal, check the IRMA brackets. Spread conversions across multiple years to stay under the thresholds. Mistake number 6 is forgetting about your heirs. The Secure Act killed the stretch IRA. Now non-spouse beneficiaries must empty their inherited IRAs within 10 years, often during peak earnings years. Imagine your 45-year-old daughter inherits $800,000 in an IRA. She's earning $120,000 at her job. If she waits until year 10 and takes it all out at once, she'll pay 32 to 37% federal tax on $800,000. That's potentially $256,000 or $296,000 in taxes. But if you had converted that IRA to a Roth at 12% during your retirement, your tax cost could have been $96,000. Your daughter inherits it tax-free. The math is pretty brutal. Pay 12% now, or your kids pay 32% later. So your action step is, if leaving money to your heirs is part of your plan, prioritize Roth conversions. Your 12% bracket is a gift to your family. Mistake number 7 is having all your money in one tax bucket. So here's why diversification matters. Tax rates will change. Your income will fluctuate. Healthcare costs will spike. If all of your money is locked in IRAs, you have zero flexibility. The ideal split for most retirees is 30 to 40% in tax-free Roth IRA, Roth 401k, and HSA accounts. 40 to 50% in tax-deferred traditional IRA or pre-tax 401k. And 10 to 20% in a taxable brokerage account. This gives you options. Need $50,000 for a new roof, but don't want to spike your income? Pull from your Roth. Want to stay in the 12% tax bracket? Mix and match withdrawals from different buckets. So here's a real example. My client needed $80,000 for medical expenses. We pulled $30,000 from his IRA, staying in the 12% tax bracket. $30,000 from Roth, tax-free, and $20,000 from taxable accounts with minimal capital gains. The total tax cost, about $4,200. If that had all come from his IRA, we would have paid $13,600 in taxes and possibly triggered IRMA surcharges. So the action step is calculate your current tax bucket allocation. If you're over 80% in one bucket, start rebalancing through strategic conversions and contributions. So let's recap the 7 mistakes. Waiting until 73 for first withdrawals cost $127,000. Converting during high income years cost $108,000. Ignoring state taxes costs $55,800. Triggering Social Security taxation cost $102,000. Spike in IRMA penalties cost $10,000. Not planning for your heirs cost about $200,000. No tax diversification cost about $154,000. Added up, and these 7 mistakes cost about $847,000 or more over a retirement. The good news, every single one is fixable with planning. So here's what to do next. First, calculate your first future RMD using the IRS tables. I've linked the official calculator in the description below. Second, map out your gap years between retirement and age 73. That's your golden Roth conversion window. And third, run the numbers on strategic Roth conversions. Take your IRA balance, divide it by the years until 73, and see if you can convert that amount annually while staying in the 12% or 22% tax bracket. And fourth, this is critical. Check your state tax situation. If you're planning to move in retirement, that alone could save you 6 figures. And fifth, look at your current tax bucket allocation. If more than 80% of your retirement saving is in traditional IRAs, you need to start rebalancing now. I put detailed worksheets for all 5 steps in the description, including the exact formulas I use with my clients. Now, here's my question for you. Which of these 7 mistakes surprised you the most? Drop a comment below with the number. I read every single one, and one of them just might inspire a future episode. And if you found this valuable, hit the subscribe button. I post new retirement tax strategies every week that can save you tens of thousands of dollars. This is Brian, the Wealth Decisions Guy. And remember, the best time to fix these mistakes was 10 years ago. The second best time is right now. Hope to see you next week, and thanks for listening.